Well, turning now to the Treasury market, the chatter among traders these days might be best described as move over quantitative easing. Here comes Operation Twist. So what is Operation Twist and what might it mean for the markets and the economy? Well, our next guest is certainly qualified to answer that question. Lyngen is a senior government bond strategist at CRT Capital Group, and his U.S. government strategy team was just rated #1 again by the Institutional Investor for this year. Ian joins us now from Stamford, Connecticut. Ian, always good to have you on Fast Forward. So very simply, what is Operation Twist?
Well, Lisa, Operation Twist is the Fed's decision, if they do take it at the September 2021 meeting, to reallocate their holdings of treasuries from the shorter term to the longer term securities. So presumably selling the 2 and 3 year and in sector and buying 7s, 10s, and maybe out as far as 30-year treasuries.
What does this accomplish?
Well, it accomplishes the goal of bringing the yield curve down, or the longer end yields lower, which presumably will at least add some stimulus to the economy by encouraging more borrowing with lower interest rates for corporations, at least, if not the end consumer. And there's a big open question out there, and that is, will lower long end rates actually lead to retail credit generation? The problem, as the Fed sees it, isn't necessarily the ability to lend, but the willingness to borrow at relatively higher credit standards than we had before 2008 and 2009.
Well, Ian, this is a point that Bill Gross has brought up. It was in a piece he wrote earlier, I think in August. And here's what he says in talking about Operation Twist. He said the Fed may in effect lower the cost of capital, but destroy leverage and credit creation in the process. You just touched a little bit on that. But do you agree with this? Could it actually backfire for the Fed?
Well, I certainly think that that is a risk. It could reduce the amount of risk that people are willing to take and the need to try and extend further out the curve in search of yield. Because if you're not picking up a great deal to go out from the 5 to the 7 or the 7 to the 10-year sector, the idea of layering additional credit risk on top of that might prove unattractive and implicitly backfire to some extent from the Fed's objectives.
So, Ian, how does this translate into the market movements? Already the spread differential between 2-year yields and 30-year yields has come in quite a bit. We're almost at sort of the 1-year low. We have a little graph here you can see of it. What happens when the president speaks, and what happens at the next Fed meeting that changes that?
Well, the president's speech, he's expected to introduce an extension of the payroll tax cuts and potentially some more stimulus-oriented bills. Maybe it's an infrastructure bill. Maybe it's a corporate tax holiday of some type. While ostensibly these might help promote growth and be bearish for the Treasury market, push yields higher, we do have the sense that it might be a little small package size and be a bit of a disappointment as far as the Treasury market is concerned. I think the bigger event is going to be the next FOMC meeting on the 20th and the 21st. And at that meeting, if the Fed does announce a Operation Twist of some type, you might initially expect that the curve would flatten further, 10s and 30 years rallying with those yields dropping, and that could push the 2s, 30s curve even flatter. But if the experience that we had in QE2 with the introduction of the second big round of Treasury purchases is any guide, what we might actually see is a reversal of the price action that is being put into the market thus far. So a little bit of buy the rumor and sell the fact.
What are you recommending to clients at the moment? I mean, you've done a great job sort of outlining the possible scenarios and reaction from the market, but what do you think is likely to happen?
Well, we still see some room for the 5s, 30s, and the 10s, 30s curve to flatten into the FOMC meeting, but we'd be cautious on the way out of the meeting and be quick to switch around and play for a curve steepener if, in fact, the Fed doesn't shock the market or impress the market, rather, with the size of the operation they choose to do.
So at this point, you're good owning the 10-year Treasury. You would actually, if a client came in to do a trade, you would say buy the 10-year at this point. You'd sell the 5-year.
Well, the 10-year at 2% is by no means a screaming buy as far as the Treasury market goes. We do see the potential for a bit of a backup because we do have supply considerations next week with the reopening of the 10 and 30-year auctions. That could weigh on the market a little bit, but we certainly do, as the economic data continues to deteriorate and the situation progress, see the potential for a 175 or lower yield in the 10-year sector.
Wow, 175. Got to leave it there, Ian. Thank you so much for joining us today. That was Ian Lyngen, Senior Government Bond Strategist at CRT Capital Group.